that. Okay, financial advisor Warren Ingram, he's in studio with us this evening. All your eggs in one basket. Elaborate.
Good evening. Happy Thursday.
Happy Thursday. Happy Thursday. Why do you sound so apprehensive? What's concerning you? Why are you worried?
I've just been listening to the show and all the stuff.
No, it's up to you now. Lift the mood. Lift the mood. Lift the mood.
So let's talk about, I guess, a typical middle-class South African. That's someone that, their biggest asset is probably their home. And it might not be completely paid off, but it's something that they are busy paying off, and that will represent, for most of us, that will represent the biggest asset they'll ever own. And usually, if they're working in formal employment, their second biggest asset will be their pension fund. And if they're sort of middle of the road, in other words, somewhere in their 40s, and have started to build it up, that's probably their second biggest asset. And what's interesting about that will be that most likely there'll be one share that represents a huge chunk of their pension fund, and that will be this tiny little company called Naspers, which at the moment, I'm being sarcastic, tongue-in-cheek, very large, enormous business that represents somewhere between sort of 15 to 20% of the value of the stock exchange at the moment in one share.
But it's only a problem, is it not, Warren Ingram, if you are invested in an index fund and in a general index fund, say if you're in the Satrix 40, for example, you're very heavily skewed to a handful of companies. A large proportion of your well-being depends on those companies. And previously we've talked about index funds and how good they are and how great it is to diversify and the low cost. But suddenly in South Africa it becomes a little bit concerning to go into just the plain vanilla Satrix 40 because of the enormous weighting of the likes of Naspers in that.
And I think it's, so you're right, that is definitely a factor with that top 40. But then there's another index called the Swix index, and that's relevant in this conversation because that's the shareholder weighted index. So that's the one most fund managers in South Africa would say, when you want to judge our equity performance, please judge us against the shareholder-weighted index. And what's interesting about that is that's where Naspers represents an even greater weighting than the top 40 index. And why I make that comment is, a lot of fund managers are very aware of that benchmark, that index, when they create their own portfolios. So very often they'll say, you know what, we're not really bullish on Naspers at the moment, so we'll look at what the index weighting is, and then we'll invest a bit less than what the index has. Because most fund managers, the first thing is they don't really want to get fired. And if you're in a portfolio that has an underweight to Naspers and it goes up, well, at least you had a good exposure to Naspers. And if it falls terribly, you could say, well, I didn't have the full weighting and I certainly wasn't overweight Naspers, so you can't fire me. And that's sort of where the index-aware investing comes from. There are actually very few fund managers around, especially in the pension fund space, that will take what might be considered a radical position. So, for example, to say, you know what, we have zero Naspers. Because if you can imagine, in the last 5-10 years, if they had taken a position like that, they wouldn't have done their investment clients any kind of favors. That Naspers has done incredibly well. So you're kind of caught between the devil and the deep blue sea here, because you might feel that you don't understand the business and that it might be expensive if you did come up with some kind of evaluation, but that doesn't mean that it can't double and double again, because that's what it has done.
No, but okay, so here's my difficulty with this hypothesis, all right? Now, and I know you're not averse to the investment strategies of Warren Buffett. You're familiar with the guy, right? The founder and the chief executive of
I've got a picture of him on my on my wall.
In your wallet, yes, I know, and on your ceiling and on the fridge, everywhere.
The Sage of Omaha.
T-shirts. Yeah, I think you bought boxer shorts with his face on them, didn't you?
And I even wear the cap on weekends.
Okay, so you're familiar then.
I'm committed.
In 1968, if you'd taken $38, and I don't know what the exchange rate was in 1968, but let's say it was 1-to-1 on the dollar. That's a safe assumption. 38 Rand at the time. Today, that's the equivalent of about 3,000 Rand. If you'd invested that 38 Rand in Berkshire Hathaway and you'd left it there, today it would be worth about 3 million Rand. And that's buying one share in one company. Why diversify when you can do that? That's your patient look, and that's your patient side.
No.
No, I'm going to have to educate you.
No,
that's good.
No, I'm thinking it's a great question, and I could be, we could be sitting here in a few years' time, and you'd be saying, look at what Naspers has done now. It's now 52,000 rand a share or whatever, and I'd be proven 100% wrong on that individual share, but I always think about shares like Enron. Which went on a massive tear and had this new revolutionary business model, and today is worth less than zero. And in the South African context, the kind of when I was growing up in the markets, the darling of the markets at the time was a wonderful business, and I say today it's still a wonderful business, but very different share was Dimension Data. And in my recollection in the 90s, sort of it went when I started tracking it, went from 3 rand I think to 70 rand, which is a heck of a jump, and then went from 70 rand all the way back to 3 rand again, and then got bought out
at 10 rand by Japanese investors. Yeah,
and so if you said, well, let's why would we diversify out of a business like Dimension Data, which was and still is in some ways taking over the world, when you got it at 3 and it's now at 65. I think a lot of people would have been really happy to have kind of spread their risks a bit out of Dimension Data, when it started going from 65 to 70 and then all the way down again. And that's really the point. Is there's a huge difference between a great business and a quality share, and I think that's my concern. Is even Berkshire is slightly different to me in that. It's kind of a spread of a range of companies right across a range of sectors now, and a range of geographies, etc., etc. Whereas to me, Naspers is invested in a range of different businesses, and in some ways, I feel it's almost an investment fund. In many ways, it's not. It's certainly not classified as a fund, but it's a company that's made a large number of investments in a range of different.
It's a bit like a unit trust in itself because it is so massively diversified. But I thought the answer you were going to give would be, well, it was in 1968 and you had no clue what the next 50 years were going to look like. So you wouldn't have done it with any level of confidence, which is why we diversify into the future, because we can't see the future. Hindsight is a beautiful thing and a very useful thing, but to learn from, but it doesn't make us any money.
And I think to me, I'm not afraid of riding. I guess the analogy here is that you have to ride the tiger. If you want to do want to take that concentrated view, then you've got to ride the tiger, and that's great. And until either the tiger throws you off or you fall off, and then all of a sudden watch out. And that's the problem with riding one share and allowing that to become a major part of your wealth. Is you really end up if it goes wrong. You end up being horribly hurt from a financial point of view.
Don't you wish you bought PSG 20 years ago, or just Capitec at 70 cents in 2002, and it's sitting at $700 or wherever it is today? I mean, we all dream of having made that decision, and dream of having resisted the temptation when it doubled in price selling it, because so many people, a share goes from 5 rand to 10 rand, and they go, oh, okay, I've made 100%, I must sell it now. And then, like famous brands, it goes up. I think it's been as high as $160. And everybody feels stupid missing it, and nobody buys it because they think it can't possibly go any higher. And that's the trouble with highlighting glory shares, because you don't know they're going to do brilliantly ahead of the time.
And I think so Capitec's a fantastic example, because I mean I can remember that share listing and thinking to myself, that's you're taking on an incredibly competitive market. You're taking on the big banks in South Africa, that are far ahead of many of their competitors worldwide when it comes to certain parts of the way that they do business. They're used to incredibly complex markets, which this is an incredibly complex market, and they've been competing head on. For a large number of years, in the beginning in a very isolated market, and now in a global market, and they haven't been decimated by global competition. These are well-run, serious businesses, and here, here comes a little business from Stellenbosch that's going to take on the world, and I was thinking, it's maybe worth a punt, but I certainly wouldn't go and take my my life savings and commit myself to that in the early days, and boy was I wrong. and it's it's made massive inroads. But at the same time, if you had to shoot yourself all the way back in time to that point, I don't think many people would have taken their life savings and committed it to that. And that's really what you would have needed to do to make that kind of big money in something like that. And it's the same with Berkshire in the late 60s or Naspers. I think, as you say, hindsight's wonderful to look back and make those calls. But I think, if you're going to ride the tiger, to me, at least every now and then take some profits and bank them and move them on into other things that are less glamorous, less sexy, that don't look anything like that tiger that you're riding. So at least if you fall off, you've got some padding.
Yeah, I mean, that's the thing. So, okay, let's go back to the real world, and let's go back to somebody who is putting 300 Rand a month away into a unit trust, or putting 300 Rand a month away into a Satrix product. And what do they do if they're worried about the fact that their investment that they're making is heavily weighted to one or two particular companies?
So I think the nice thing in our market now is that the exchange-traded fund market is getting more sophisticated in some ways, and has certainly adapted to many of the criticisms launched at index trackers by the fund managers, and that most obvious one has been this Naspers example, and so there's a very simple index called the equally weighted top 40 as an example, and what that does is it takes if you're going to invest 100 Rand into something like that, it would say, okay, well, let's split that 100 Rand across in the same proportion across all 40 shares in the top 40 index. And so, yes, you'll still get exposure to the Naspers if it then doubles again, but if it, and you'll get some benefit out of that. But if it halves, then at the same token, it's not going to collapse your whole portfolio when you've got a 20% exposure, because you don't have that 20% exposure. You've got a much smaller allocation. And to me, that's a very nice route to follow for somebody who is starting out and who wants to create that sort of core investment in their portfolios. Look at that equally weighted top 40 index and buy that. That's a very simple way to do it. The alternative would...
So the upside of that is that it removes risk. It reduces... It doesn't remove risk. It reduces risk of being overly exposed to... I don't know if any gold shares left in the top 40, but at one time gold shares were rapidly falling out of the top 40 and you didn't really want to own them, but they were quite substantial portions of it. And you might not have wanted to own gold shares, but they were there. You could do nothing about it. So if you bought this equally weighted top 40, that would have made the value in this portfolio out of 100, say, exactly the same value in gold shares as in Richemont, as in a bank or a cell phone company, for argument's sake.
Exactly. And I think so you're right. It doesn't remove risk, but it certainly does what we like when we're looking at risk, and to diversify that risk across a much wider range of sectors and companies than having that huge exposure to one or two or five businesses, which has really been the case in the last 5 or 6 years. Five companies.
I'm somebody, when confronted with a tray of cocktail sausages, and there are 5 left on the tray, I'm not likely to leave any of them behind. I'm a little bit greedy. So I don't want to limit the upside either. So I want to have a portfolio of shares with the weightings that suit me. And that's the trouble with these things. We don't want to lose money, but we also don't want to lose out on... We've seen what Naspers has done over the last 10 years. We say, what happens if it does do it in the next 10 years and we've gone all conservative? Isn't that the downside then of taking all of that risk off the table?
Well, but I think that's the point, is you're not taking all of the risk off the table. What you're doing is you're still... to give it a context... to have 100% of your newest savings, if you're starting out and you're doing your 300 Rand a month, and you're committing that all to an equally weighted top 40 index, that's actually still pretty risky, and it's still going to give you the potential for very good growth, because you've got 100% of your savings in shares, and shares traditionally going to give you 15% a year over a long period of time. That's pretty good growth, and that includes a whole lot of previous Nasperses, etc., and all the bad stories, but you've still got that as kind of the core of what you've got. If you start to save a bit more, then by all means take additional risk and let that be, if we're cooking a stew here, Bruce, the Naspers then, or that concentrated view, is the chili. And, as chili can help a meal or it can destroy a meal. And it can have some pretty nasty side effects.
Some people like more spice than others.
And that's okay. I think that's the point, is you're not going to eat a meal only of chili. And so maybe your cocktail sausage example, I'm rebutting with my chili example.
And yours is stronger. Warren Ingram, he's a financial advisor at Galileo Capital. Wrap up with him in just a moment. If you've got a question, if you'd like him to tackle it for you, give us a shout on 011 883 0702 021 446 0567. It doesn't have to be about chili.
The Money Show. Personal finance.
Warren Ingram, brace yourself. David in Rudderput, quick question for Warren Ingram.
Hi, Bruce. Hi, Warren.
Hi.
I just want to know, I just have $800 to spend every month. I don't understand how these investment things work. I just want to know, how do I invest it in shares, and what vehicle must I use?
Wonderful, wonderful, wonderful question, David. Thank you. The first thing you do is you take about $250 of that 800, the first 800, and you buy Warren's book, How to Make Your First Million. Seriously, that would be my first tip. But broadly speaking, generally speaking, Warren Ingram, for somebody starting out, don't go in blind.
No, and I think there are always going to be a couple of questions that you ask before that, and one of them will be, if you've got any debt, especially personal loans, credit cards, store card debt, etc., then please don't start saving and investing until you've paid those off. And then secondly, try and have an emergency fund. That can be in a money market account that equates to about 3 months worth of your expenses. So if you spend 10,000 rand a month, then you need about 30,000 rand in a money market account, and that's really for emergencies. It's not the holiday or the handbag.
Yes.
Then, I'm there. So
you're not giving financial advice. You're just answering a question.
Come on, you've got to cover the spectrum here. So
I've got another great question.
Okay, all right. So then the last part would be, take $400 a month, put it into something like an equally weighted top 40. Take another $400 a month and put it into something like a world index, which you can buy. And you can there are lots of these exchange traded fund platforms now. And you can buy it at a stockbroker or
David, I mean, we're using language that you're not necessarily, because you're not involved in markets and stuff. But if I'm seriously advise you to buy and read the book, and there are lots of books. I mean, Maya Fisher French's book on money is very good. There are a couple of very good local books on investing and on money, and you need to become familiar with the terms. So the equally weighted index is one of them. Buy an exchange traded fund, offshore exchange traded fund. You need to familiarize yourself with the terminology that is used and understand what's in there. But it is a case of, David, there are so many options that are open to you in terms of buying very simple unit trusts or buying index products, as Warren recommends. So I wish you luck with it, David. But most importantly, for the next month, just listen to us and buy the book at the same time. And if you get to a point in the book and you want to ask Warren a question, he's here every Thursday. You can phone him up and say, page 74. What do you mean by this?
You said this.
Yeah, you said this, and now I'm confused. Margie and Kyalami. Oh, it's a red rag to a bull question, this one, Margie. Your question for what? Margie?
I'm looking at selling must I turn the radio off?
That's a good idea, Margie. That's a good idea.
Yes, I'm looking at selling my Satrix Divi and buying Bitcoin.
No!
Don't shout at Margie, Warren. Margie, thank you for your question. I love the question because I think many people are tempted by hype. And Warren has gone puce, which is a deep shade of red if you don't know what puce is. And he's concerned about you, Margie, and he wants to help.
Please don't do that. So there's, Bitcoin and that whole cryptocurrency, the blockchain, etc., there's undoubtedly it's going to be game-changing in many ways. But right now, to me, it feels a heck of a lot like a range of bubbles that we've seen in investment markets over the last many centuries. And I'm not even talking about decades, and I'm not exaggerating. If you go back and just Google the tulip bubble, it feels to me a heck of a lot like the tulip bubble. And why I'm saying that is, I
used that analogy last week, and Simon Dingle shouted at me. He said it's not the tulip bubble. But I'm so glad that you think so.
Yeah,
good.
Well, Simon's not an investment guy. He's a tech guy. So just to explain that, I think that there's merit in this, and it's a bit like the gold rush in South Africa. The people that really made money consistently and reliably were the people that were selling the shovels and the diggers, etc., and not necessarily people who were speculating on individual little holes in the ground, hoping that there would be diamonds or gold there, etc. And I think this is a lot like that. We undoubtedly know there's a heck of a lot of potential investment gold in this new field. But the problem is we don't know that this is the one. So rather stick with your investments and please don't go and sell out of a whole lot of things. To get into something like Bitcoin, which may just go all the way down again. It's had a few bubbles already, and I think this one that we saw in this last little while was a very specific set of circumstances, and those circumstances will change again, and then it could fall over again.
Margie, please don't do anything rash. I think that's Warren's guidance. Financial advisor Warren Ingram this evening. He's with Galileo Capital. He's a director there. He is a financial advisor. And he is here with us every Thursday night. He's also written a book, two books. Become Your Own Financial Advisor and Make Your First Million. You should read them back to front.
Can I just say one thing about that book?
What about that book?
I think it's not official yet, but I'll get the numbers in the next week or so. But I think we are officially a bestseller.
No, you've sold 3.
4.5 now.
Wow.
So I think we are it'll be come out soon, but I think it's officially a bestseller, and I can also tell you that the first royalties have come through,
yes.
And that means that
where are we going on holiday?
So that means we've got enough money to pay for 1.5 years of school fees so far, and we'll get more.
I mean, I'm making light of it. But the beauty of these books, and people often criticize me for punting Warren's books, and I will only punt it because I believe it's really good. And the royalties, because when you write a book, there is a royalty in every book. It's not very much, and you've got to write an awfully large number of books in order to get enough royalties to live off. But Warren doesn't live off the books. He doesn't keep a penny of the books. The books go to a trust that he set up called the Serendipity Trust. The Serendipity Trust is set up to help people go to school. And it's a really good move. And so Warren Ingram is our weekly financial advice guy, and he is with Galileo Capital.